Welcome to another Fran Pro Insights call. So this is an interactive series. We're going to make sure that we get you all the answers and insights. I want to gather all the intelligence from the industry and make it available to you so that you can go here. Now remember, every video has chapters. You can click on the chapters and go right to what you want to know. You can go forward and backward, re-listen to it, and please take a second and fill out the information and feedback below. That's how we'll know what questions and answers to get for you in the future. Now on this call, a few of the things that we'll go into is what to look for in a franchise. Also, how Brian's company lost 95% of their business, survived, and how they're making more profits now than ever before. And also he's going to go into the invisible killer that puts people out of business and a lot more. So listen up, here we go. So Brian, from your experience, what are some of the biggest mistakes or false beliefs that you've seen struggling franchises make?
Okay, so for starters, the thought that the lender is kind of the enemy, the lender is on your side actually. Like they're going to make sure that everything makes sense, the cash flow projections look right, you can qualify to do it, you have enough working capital to do it. We always add extra working capital in because businesses don't go out of business if they've got too much cash, right? It's only when there's no cash left. So I think that's one of the things. Also, not wanting to do business plans or projections or whatever and feeling like that's intrusive. The truth of the matter is, if my son came to me and said, "Dad, I want to start a business," I'd make him do a business plan because it forces you to look at your competitors, do a SWOT analysis, strengths, weaknesses, opportunities, threats, run your numbers and make sure if it even makes sense to do. It's possible that you could start a business that never has any chance of making money based on where you're at or whatever. And so, maybe a competitor down the street. So do that business plan. It's just a great way of making sure that what you're doing is smart. And the lender is also going to make sure if the lender's approving you, the chances are that you're probably going to succeed, because that's a lot of smart people looking at the deal and saying, "Hey, you can do this," So.
Yeah, I've told clients, I said, listen, probably the most unfun part is going through and doing that whole business plan and everything. But I said it's necessary because, the bank, they want to know that you understand this business and you have a plan to succeed because they want their money back,
That's right.
And if they don't think you're going to succeed, you're too risky. So even if it doesn't seem like something that you want to do, I said it's good to do it. Just like going through the FTD, you should read it several times. You need to know what's in there, and you need to have your business plan, and having someone else write it for you. Some people, I'm sure they do that, but then you really, if that's what you do, you really have to read it. But you need to write it and you need to own it and understand it, because that's also your plan to not just to execute on, but your plan to how are you going to make this work. So I think that the lender is in it. And I tell people, when you look at franchise, you have, if you're working with a consultant or broker, they're evaluating you, to see if it makes sense. Then the franchise is evaluating you, and then your lender is evaluating you. So you're having all these people evaluate to make sure that it looks like this is a good fit, that you're going to be successful. No one can guarantee anything, but at least people are putting in their time and effort to do that.
That's right.
What do you, because you tell me great stories and you tell me horror stories. What do you see top performing brands doing differently than struggling brands?
So I think two things to look for if you're, trying to figure out a franchise is, one, how do they screen out, applicants? If it's a brand that just everybody who fogs a mirror, they try to get them to sign the upfront fee, then that's trouble, down the road. But if they take the time to get to know you, they pre-screen you, they maybe check your credit, etc., they're really trying to determine if you're someone who can be successful with that brand. Like you were saying, they're analyzing you to make sure you're going to work, because the good brands don't want a bunch of people failing. They want everybody to be successful, and then look for a strong support team. You're gonna be looking at different properties and all these things, and you want them to have a good back of the house where they've got their people in place. And it doesn't have to be a giant brand. It can be a small brand just started by people who know what they're doing, and they've got the support system in place so that they're there to help you. Because there are some locations in a town that are better for a particular brand than other locations, and they should know from their experience which ones those are, and that they should be able to help you with that. So there's lots of things all down the line that if they've got a good support staff behind them, I think that's going to really improve your chance of success as well. Because a good franchise takes a lot of the risk out of a business startup away, really, because they've got proven systems. You just want to make sure that they can help you and they're not too overburdened with whatever they're doing, so that they can make sure you're successful too.
Right. Yeah, because you told me about people that were growing so fast, but the franchisees were struggling, but they were still loading people in.
Yeah.
And, there's got to be some red flags. What would you say to the franchisors as some, hey, I'm a franchisor, I'm getting started. You've seen big brands, you've seen small brands struggling, high performing. What advice would you give to the franchise companies?
Well, if it's brand new, they've got to get on the franchise registry, right, with the SBA. So they got to go to the SBA, and you can go in there. But I would say that make sure that you are clear on the type of person you want to bring in to your company. Mm-hmm. We mentioned on a different video, me and you, that I helped Firehouse Subs grow across the way. They had an interesting thing. They'd have a day of discovery, and they'd fly the potential franchisees down, and they'd spend a day at corporate, and they'd meet the owners, et cetera. And the one thing they wanted in the back of their minds, they were looking, would we want to fish with this guy? Believe it or not, they just wanted people that were kind of like them, kind of friendly, kind of whatever. They were clear on the type of person they wanted to recruit, and they did very well. There are 1,000 locations now or whatever. They've done really well. And I think Burger King just bought them or something. But, so make clear on who you want to recruit, and then just make sure you support them. You make sure they're successful,
Mm-hmm. So what are a few challenges that commercial capital ran into when it was growing, and how did you solve those?
Man, the worst challenge we had was the 2008 market crash. Whereas much of the world went into a recession, the commercial mortgage-backed securities market shut down completely. So we lost 95% of our business in 3 days. You couldn't even get an SBA loan because the pricing was so bad that the banks couldn't sell the paper. So once you had that crash, we had 700 branches across the country in 2007, 785. We were monstrous. And then we lost 95% of our business. And I foolishly thought that it was just going to quickly turn around. It was just a blip. And a year later, after paying everybody's salaries, I drained all my resources. I had to just completely reorganize my business, and I made it loan officer centric, so that it's basically me. When you call into commercial capital, you're going to get me. And so it's not a legacy thing. My son does work with me, and I can bring in other family members, but it's not something where it's a legacy thing. But it's something where I know that I'm marketing. I know that I'm doing the business, and I know what I'm doing. And so if the market corrects again, I will gain market share because I am doing it better than everybody else. And that's kind of happened. Commercial volume has slowed down some, but I'm having my best quarter ever. And so I'm gaining market share as we speak.
Yeah. I remember when I was talking with you, you're like busy. Things are busy. Like
very busy.
It was hard to, get time in for this call. So
Was, yeah.
Well, it seems like, by keeping your sales ahead, your costs down, admin down, sales up, you really have a business that's always focused on keeping fed and not costing too much. And I think other businesses can take that concept and use that too, because that's,
Absolutely.
Otherwise you don't get bogged down in all these expenses that are dragging you down.
Right. Yep.
So, one other thing, what's some of the most valuable business advice you've heard or discovered or ever shared?
So, I think one of the best things I ever heard was your inflow must exceed your outgo. Even if it's by $1, if you bring in more money than you pay out in expenses, you've turned a profit, right? Where it gets deceptive is people, if you're growing your debts, then you're not turning a profit. So you might start the month with 10,000 in your bank and pay all your bills and everything, and then still have 10,000 at the end of the month. But if your credit card balances grew by 5,000, you actually lost $5,000 that month. You didn't turn a profit. You might feel wealthy because you still have 10,000 in your account, but you actually lost money. And if you do that for too long, then you will be in a crisis situation. And so you can't allow that to happen more than a month or two. And an occasional odd time when you've got a lot of expenses one particular month, that's one thing. But if every month your debt is growing, that's a huge, huge warning sign. That you're losing money. And I think the second one would be try to grow your sales constantly, but also keep your costs, look at your costs constantly. So you want to be doing both and adding revenue streams and new markets to grow your sales, but be looking at the costs that you have and try to, renegotiate different contracts if you have them and cut costs where you can. I just reduced my costs in my processing division and increased my productivity. So, my profitability is going to go through the roof because I was growing sales and cutting costs. It's doing both at the same time if you can. Don't just get all about sales and forget about your costs, and don't get all about cost cutting and forget about your sales. You got to do them both.
And I could see how having that increase of debt could actually make you believe that, not even realize that you're getting pulled down because you're not seeing it. It's just a debt balance, but your bank account looks good.
I know from experience, that's what happened to me in 2008. I was a millionaire on paper, but I also had $1 million worth of debt. I had $3 million worth of assets, but I had $1 million worth of debt. And when the market crashed, that $3 million of assets went down to 500,000. All of a sudden I'm upside down and I'm not, and it took me years to pay all that off. I didn't file bankruptcy. It took me years to pay it off. But I thought I was flowing because I had millions running through, but actually today I'm way more profitable than I was back then. And I'm still only a third of the volume I was doing at my high in 2007 as a company. But I'm 3 times more profitable than I was back then with no debt, really. So,
and just from talking with you and listening to you, I can see how that would be beneficial, because when I talk with some people, you get a rep that works for a company and they're getting a salary, and so they're just like, if I close it, if I don't, they don't have this drive to make it happen. They're not hungry, and so they're just sitting there content, and they're just like, and you're focusing on making sure that deals close. And that, I think, is one of the big things that stands out about you.
Insurance companies get residual, right? I don't. If I don't close the loans, I don't make any money. I don't feed my family, my 6 kids. So I have to work and so I am very, very focused. I'm only going to take in loans that I feel I can close, but if I do take it in, I do intend to close it. Because otherwise I'm wasting my time, and that's not fair to anyone that counts on my support, So, you got to be on it, man.
Last question. Brian, are there any trends or new technologies that you think people should keep their eyes on?
So, I'm not a tech guy. But you need to be aware of what's happening in the marketplace, and pay attention to potential disruptions. We're speaking here on what, Tuesday. Last Friday, a big bank went under, so there was a lot of hubbub on the everything about banks. Are they in trouble? And most banks are very healthy, so that's not a problem. But whenever there's disruptions, there's always opportunities, and so be aware of the opportunities that may be present. Don't be afraid of things to come. There are a lot of warning signs in the economy and other things to make one doubt, but there's always opportunities to make money. There is always going to be people eating out. There's always going to be people using things. So the Roman Empire fell, right? But I could still go to Rome, Italy today, thousands of years later. Georgia's not going to disappear off the map if the Federal Reserve keeps raising rates, So there's always going to be business around. You just have to look for the opportunities, and see where they are. I'm always looking. The Fed started raising rates last year, so now this year it's very beneficial to refinance 7A loans into 504 loans. So now I'm doing a lot of refinances. Last year I did no refinances. Now I'm doing more refinances because I'm saving these people 3% and 4%. So I'm just looking at the opportunities constantly that are and trying to take advantage of them with product that I have.
Right. And business is really about solving problems. And so what you're saying is when these big problems come up, it's not that you should worry, it's that you should go, whoa, if I have the solution for this, or a solution for what the problems that are coming because of this current situation, I can really grow. There's some companies that really grow. Back when we had, COVID, I mean, there was companies that just went off the charts because they were in a good position and they ran with it.
Zoom was one of them. We're on a Zoom call right now, right? Zoom just took off because of COVID lockdowns. So, there's always an opportunity. They made lots of money during that time. So, absolutely.
Well, thanks, Brian. I appreciate it.
Thank you, buddy.